participantes de este webinar. Soy Carlos Giraldo,
I'm
director de
Carlos
estudios económicos.
Giraldo. I'm the Director for Economic Studies of the FLAR, Latin American Reserves Fund. I would like to welcome you to this webinar organized by the CAF and FLAR, talking about the resilience of the financial system in Latin America during the pandemic. I would like to invite the chair, the executive chair of the FLAR, Jose Dario Uribe, to open this event. Thank you. I would like to particularly greet everybody connecting and listening to us. I would like to welcome authorities, technicians from central banks, including those who are going to be speaking today about this subject mentioned by Carlos, which was included in the invitation to the authorities and central banks in the region, representatives of international governments, thought centers, academics, and people from the private sector. I would also like to particularly welcome Dr. Sergio Díaz-Granados, the executive chair of CAF, the Latin American Development Bank. CAF and FLAR continue to work together to find areas and spaces for virtual technical discussions, such as the one we have today with people from 4 important central banks in our region. In December 2020, during the first months of the pandemic, we studied and talked about the situation of the financial system after this severe shock experienced in our countries and the measures, ordinary and extraordinary measures, implemented in the monetary and financial spheres. Back then, the uncertainty about the progress of the pandemic and the economic situation was great. We have seen an impact on companies and the effect of the crisis. If it had led to a financial crisis, they could have been much more long-lasting. Until now, this has not happened, and there may be many reasons for this. And we will be talking about this in greater depth. We are going to be hearing from top-level experts that we have asked to join us today. The economic situation has been a challenge. We have to think of external and internal factors. If we talk about external factors, we have the Russian-Ukrainian conflict at the moment, which is having an impact on the economy of the entire world. And we've noticed them in certain ways. For example, upward pressure on production costs and prices, and therefore inflation. An escalated conflict could lead to risks around the world and financial risks. On the other hand, if we talk about the interest rates of the Federal Reserves, this represents a challenge when it comes to the flow of external resources, as we have seen in the past in the region. And the response in monetary and fiscal frameworks is more limited. We're looking at reforms, and different countries are looking at the needs of their population. Monetary authorities and financial authorities in different countries, represented here from the Bank of Chile, the Bank of the Republic of Colombia, or from Mexico, or from Peru, they are facing challenges in the financial sphere. They share the fact that they have robust financial departments, as are represented here today. They support the decisions taken by authorities in each respective country. I consider this conversation will be very useful to share different points of view regarding the resilience of the Latin American financial system during the pandemic and its characteristics and challenges for the future. There are many challenges for the region. We are going to be talking about macroeconomic stability, amongst other things. In Chile, as a bank related to FLAR, they represent great progress in the strengthening of the financial security network. They are involved in regional dialogue to ensure macroeconomic stability and financial stability. Without doubt, this is of great use, and we must thank you for participating in this exercise, and we hope that this day's session will be useful for everybody. I again welcome you to this seminar. Thank you. Thank you very much to the Executive Chair for those words. Now we're going to hear the opening words from the Executive Chair of CAF, Mr. Sergio Díaz Granados. You have the floor. Good morning. It's a pleasure to be able to welcome you to this event and to thank all of you for attending. I particularly thank the FLAR, Latin America Reserves Fund, and José Darío Uribe for working to encourage this dialogue about such important issues. Since 2020, FLAR and CAF have come together to have an exchange of viewpoints about monetary and financial systems in our economies through these webinars. Right now, we have an important group of representatives from Colombia, Chile, Mexico, and Peru from their central banks in order to look at financial system in the region, a region which has shown resilience during the crisis following the COVID-19 pandemic. Without doubt, the actions taken by the central banks to provide liquidity and to reduce the cost of credit were fundamental to prevent disruption in the domestic economies. And domestic credit or consumer credit was maintained, and it also had a counter-cyclical role. Regulatory changes to encourage facilitate conditions for credits also helped, amongst other things. The resilience of our financial system is notorious. After the partial withdrawal of the aid and the stimuli and the changes in regulation, we still see liquidity, solvency, and a modest deterioration of the portfolio. But the setting is changing, and we expect to see a slowdown in activity as of this year, and then a pickup in. We're going to be looking at changes in interest rate, and we may see this to be quite aggressive following the situation and the changes as a result of the war in Ukraine. This will have an impact on the homes and companies and governments that are more in debt than in the past. And we could see a complication. We may see recovery affected for the more vulnerable homes and companies. The technicians from the central banks will help us to understand the resilience that we have had in our financial systems until now and the challenges that they are facing when it comes to weaker growth and monetary policies which will be more restrictive. The task ahead of us is broad and challenging. I am sure that we are going to have great opportunities, and CAF wants to be strategic to countries to help them with their economic recovery. In this regard, it's a pleasure to be able to say that in December, and after that in the ordinary assembly this year in March, the partners or the members of CAF decided to capitalize this bank in order to prepare it for the rest of the decade, in order to meet the obligations of the countries to a better degree. This capitalization of 7 billion, which is the highest in the history of CAF, which represents the 7th, 8th and 9th, and it will be a much stronger CAF in the future to support the public and the private sector. I hope that you have a very enjoyable webinar, and we will continue to work with this alliance with FLAR in the future. Thank you very much. Thank you very much to Sergio Díaz Granados. The panel will be carried out by means of 2 rounds with the moderation of Adriana Riasa, the Director of Macroeconomic Studies of CAF, and myself. In the first one, we will be talking about the financial system, looking at behavior during the crisis of COVID-19. And in the second round, we will look more at stability, financial stability, and the challenges. So we shall begin with the first round, and during this we would like to, as I said, take a look at what has happened during this crisis. Particularly, we would like to look at the behavior of the main indicators in the financial system, what factors explain the resilience of the system during the pandemic, and how things have developed after the withdrawal of the extraordinary measures that were implemented during the first part of the pandemic. Each of the panelists will have approximately 5 minutes to talk about this. And first of all, we shall hear from Rodrigo Alfaro, the manager of financial studies of the Central Bank of Chile. Previously, he worked on financial stability amongst other positions that he has held within that institution. I shall give the floor now to Rodrigo so that he can tell us about his view of the Chilean situation. Thank you very much, Carlos. Good morning, good afternoon to everybody. I would like to thank you for your invitation to participate in this webinar. I would like to talk about two general points regarding the crisis. No doubt in history books we will read that this crisis was not originally a financial system, and this is different to other crises over the last 2 decades. What we were looking at was a health crisis, which led to restrictions in mobility in all of the economies in the world. And what we observed is that the mitigating factors for this crisis involved an impact on the economy of our homes. So this is a crisis quite different to what we had faced in previous decades. And the second point is that the financial system, well, there were companies which were solvent, but they began to have problems in terms of liquidity with the more restrictive measures against mobility. If we talk about Chile, there were policies that were implemented during the COVID-19 pandemic. There was a high level of coordination amongst all of the players, the Ministry of Finance, commercial retail banks, and other financial players. And with the pandemic, there was guaranteed credit which helped to reduce the problems related to liquidity. Having said all of this, and in line with Carlos's question, during this period, the credit in the bank maintained sustained growth during the first quarter of 2020, and even two-digit figures in real terms. Then we saw values more in line with the economic cycle and the need for financing of the different sectors and players. The default indicators remained at very low levels in aggregate terms. We're talking about 1.5% of placements, which is relatively low compared to past figures. But in some sectors, there was certain weakness, so some adjustments are expected. Not all sectors were able to recover at the same speed. We had some sectors more affected by the pandemic because they suffered more restrictions. There are financial indicators. The profitability of the banking sector was reduced because there was a change in the credit portfolio from homes to companies, and there was lower yield because of the kind of products different comparing companies and homes. Consumer credits provide greater profitability because they are more short-term with higher rates. They do not have such a high degree of collateral and guarantees, and we understand that they fulfill a different role or purpose. So this negative impact was offset by an increase in operational efficiency. Digital channels were used more, and this was typical of a situation of reduced mobility. And the bank adapted very quickly and began to use these channels in order to deal with the restrictions. Solvency, on the other hand, saw an increase. And as I mentioned before, there was a change in the portfolios, and there were also capital increases, which increased the robustness in the banking sector when it came to facing the situation. In the case of Chile, the banking sector follows Basel III with the compliance with capital requirements. So it was necessary to comply with the increase in capital in order to fulfill the standards that are being followed. And if we talk about resilience of banking system during this period, I would talk about a relevant factor as the provision of resources for containing risks and also for placements. Here I'm talking about provisions and capital. This last one is not just essential in order to bear losses as well as to allow for the financing, particularly in this past situation and with the pandemic. Resources were necessary in order to ensure solvency and to ensure liquidity during the period. That's from me. That's all from me, Carlos. Thank you very much, Rodrigo, for your contribution. This is of great interest, the experience of Chile. The financial system in Chile has been very successful during these times of tension during the pandemic, not just from overall phenomenon and cross-cutting phenomenon, but also due to idiosyncratic issues. The financial system, we have seen, has good indicators in general, including liquidity. And later on, we will talk about the future in the next round, and we will see what you might be thinking of for future challenges. Now I shall give the floor to Daniel Osorio, the Director for Financial Stability of the Bank of the Republic of Colombia. He has been working on the stress testing model used by this bank, and in this regard, he has detailed knowledge and far-reaching knowledge about the progression of the financial system during the pandemic and financial burden on homes and companies. So we will give the floor to Daniel so he can talk about the recent experiences in the Colombian economy. Thank you. You have the floor. Hello from Bogota. Hello to the panelists and everyone attending this webinar. And I would thank FLAR and CAF for the invitation. I'm going to share some very brief slides with you, just to support my presentation. So, the main message that I would like to share with you, which I think is following on from what we heard about Chile, is that within this system, well, the system had certain characteristics which helped it to overcome and withstand the crisis. There were mechanisms that softened the blow. So, very quickly, if we take a look at these, what happened with the financial system in Colombia during the crisis? Here I'm going to be very brief. Here we can see information from the recent past. If we look at the right, we can clearly see the impact of the pandemic and what Rodrigo mentioned. In the Chilean case, there was a drop in profitability, which reached levels that we hadn't seen since the start of this century. And then, with the recovery of the economy, there was a recovery of returns. And we can also look to the left, which tells us about what happened with the mature portfolio. Here we have the point of the pandemic, and we can see how it fell. This may be counterintuitive, and this is due to the mitigation measures that were established by the supervisor. These were temporary rules for the credit rating, and this was obviously a very severe crisis. But when these measures came to an end and the blow suffered by the economy, we saw an increase reaching very high levels in consumption particularly. We can see that as the economy recovered, the situation became more normal. And now we're looking at lower figures. This is very visible here when we want to look at the crisis. On the left, we have information about solvency and leverage, and then we have the liquidity coverage ratio on the right, and this is what we can see. If I took the data away, and if I talked about the worst recession in the Colombian economy, well, we wouldn't see. I mean, solvency remained stable. It remained stable, and then it leapt up. And this is related, just like in Colombia. Well, in the period between 2020 and 2021, we saw the entry of capital requirements of Basel. So these are accounting changes. But if you look at this, if we imagine that we didn't have that leap, we could say solvency was very stable throughout the COVID crisis. Profitability fell, but it didn't fall enough to lead to massive losses. And the same with liquidity coverage ratio on the right. There we have the banks, for example. We can look at the line for the banks, and we can see that this ratio remained very stable during this pandemic. So it's not very clear or noticeable in solvency and liquidity, and this shows the ability of the system to absorb these shocks. It didn't affect these aspects in the company. And so the system served to soften the blow, we could say. It's like a shock absorber. At the start, when the pandemic first began, we can see the real growth of credit. We can see the commercial figures went up. And when we saw this shock, the big firms, we can see how this impacted them. If we talk about consumer credit, we can see its recovery here. But in housing, this was very stable. The system had the characteristics in order to act as a shock absorber. And we are seeing that in all credit areas there is a recovery, and they are now speeding up. That's in the... If we talk about the financial markets, it lasted a very short period. On the left, we can see the net contribution of investment funds. This was the epicenter in Colombia. This was where it was more visible. We had the withdrawal of funds, and in their portfolios, so we're talking about bank bonds above all. And those withdrawals, well, they were related to liquidity problems. And so we're talking about 4 years. What can we see over these 4 years? We can see in 2020 we had the large amount of withdrawals as a result of the crisis. Then the market is stabilized, and the net contribution is stabilized. And we have seen stability in 2021, more gradual withdrawals, but nothing with a big impact. And on the right, we can see the change in the involvement of foreign entities in the local securities market. In the 2020, there was a withdrawal, a reduction in foreign investment, but then they came back. And since 2021, well, 2021 was a year of stability in relative terms, and 2022 is also a year of stability. It was a tough crisis, but it was very short-lived, and the flows quickly became stabilized. So what are the key points to the stability in Colombia? Well, I think there are four, Carlos. The first is the starting point. The system received a shock with high solvency and liquidity at the start and with a solid risk evaluation system. And this is due to efforts made since the 90s. In our region, the big financial crisis happened much earlier. And so the countries had time to progress and develop solid, robust financial systems. So they already had solvency and liquidity and could manage their risks appropriately. They were in a good situation. Secondly, we have the flexible response of financial supervision. This is key if we think that the flexible response was helpful in order to adapt the risk and credit management systems. These changes were essential in order to soften the impact of the shock. But what we've seen is that they allowed the banks to mitigate the impact of, in order to withstand the changes with regards to credit. Based on the basis of the Basel regulations, this was really essential, this flexibility. And one thing that we don't talk about a lot is the absence of significant mismatches. Here we could say that there's a lot to be said here, but what this allowed is that this lack of mismatches meant that the shock-absorbing role was possible without too much of an impact. We have regulation and limitations, and I think there's a merit can be assigned to the leaders in this process, in the regulatory system. There was a regulation in the financial system with regards to these mismatches. And in the real sector, these are small mismatches. So there was a big external shock with this pandemic, but it was absorbed without it affecting the stability of the financial system. So the role of the real sector mismatches was very important in Colombia. And the nominal exchange rate was also a shock absorber. If we talk about monetary agility, well, the response of the central bank was key. The central bank was very swift in responding to the market crises, and it ensured that the crisis didn't last for long and it didn't lead to a widespread liquidity problem. And there is a system and a regulatory system which was flexible. This allowed for example, the purchase of securities that would otherwise not have been possible. So this flexibility meant that, together with a very good starting point and the reduced mismatches, this meant that in Colombia we could face this crisis in a positive way and maintaining the resilience that we had seen in our stress tests. And I will finish with that, Carlos. Thank you very much, Daniel. That was very comprehensive presentation. And you talk about flexibility in supervision and the measures that were very useful to alleviate cash flow in homes and in companies. Right now we're seeing a new credit cycle, and we're seeing that the indicators of the financial system in general are showing appropriate behavior and in line with the resilience that we've seen in the financial system during the pandemic. Okay, now we're going to continue with the Mexican case, with the involvement or the presentation of Jorge Luis Garcia, the Director for Financial Stability in the Bank of Mexico. He has been a civil servant in this institution for around 20 years and has worked in technical groups committee for Basel financial supervision and stability. Jorge, you have the floor. Thank you very much, Carlos. Good morning to everybody. First of all, thank you for inviting me to this forum. I think it's a very important forum because we are here to talk about the keys to resilience in financial systems. I think that one of the keys at a worldwide level to explain our response to the crisis is related to the collaboration and cooperation between different financial institutions throughout the pandemic, sharing experiences, and also for dialogue and for coordinating our responses. The content of this first part of the conversation is related to indicators and resilience factors, particularly in Mexico. As we've already heard, in the case of Mexico, we did see an increase in stress in the financial system just when the pandemic started. But this stress was associated with uncertainty and lasted a very short period of time. If we look at stress in the markets, well, this is based on debt market and exchange derivatives, credit and risk institutions. We see that these indexes were similar to those seen in 2008, 2009 during that crisis. So it is an event which really did submit the financial system to stress. However, the levels returned to pre-pandemic situation. This stress was related to uncertainty. But if we look at other indicators, such as the capitalization rate, this increased during the pandemic. The liquidity hedging ratio, if we look at this just at the end of the month, this has increased throughout the pandemic. However, and here, well, I'll come back to this indicator. It was seen during the first month that some institutions in the banking sector faced a liquidity shock, and they managed to face this. If we talk about the liquidity coverage ratio of Basel, this was higher than before the pandemic. Both capital and liquidity obey on the one hand, or are due to the fact that in Mexico, credit did fall and has not recovered. This has led to the banking institutions to invest more in liquid assets, and this increases capital and liquidity. That's a challenge for the future, to reactivate the credit activities. We also saw abstention in the payment of dividends during the crisis. This also increased capitalization in the banking sector. If we look at the mature portfolios, it's not surprising that there was no increase because of the measures during the crisis. What is surprising is that when they were withdrawn, there wasn't a considerable increase in consumer. There was a slight increase, similar to before the pandemic, but elsewhere there was no significant increase. I would like to talk about some reasons why I think the financial system was so resilient and the indicators behaved in this way. There are many other indicators, profitability and such like, and I invite you to take a look at the financial stability report of the Bank of Mexico. It was published in December, and the next one will be published in June, and there is a detailed description of the indicators. But I would like to focus on 5 points which I think were key for resilience in Mexico of the system. First of all, the liquidity reserves and capital that were available to face a stress situation. Since before the great financial crisis and the responses to different crises suffered in Mexico during the 80s and the 90s, there had already been the establishment of solid regulations. Added to this, Mexico appropriately adopted the criteria of Basel III, and as a result, both the quality and the quantity of capital increased considerably, and this was maintained prior to this crisis. And another one is a new indicator. We had a different version for foreign exchange liquidity. There was a requirement for general liquidity coverage ratio. This requirement is key when it comes to facing a short-term crisis. There is a conversation internationally about whether banks should or should not use their reserves for liquidity, the liquidity reserves, and some institutions think that it should have been used. And in Mexico, I have information about this indicator. During the first days of the pandemic, there were several institutions that were facing a liquidity shock, and they did reserve their liquidity reserves to deal with this in March and April, when there was greater uncertainty. After that, there was an appropriate response by the authorities, and liquidity improved or increased. And if we are talking about 30-day shock for institutions and authorities, I think it played its role in an exemplary way. And the second reason why I think that there was a lot of resistance in the financial system is that there was a regulatory response to mitigate the impact with counting payment holidays, the possibility of delaying the payment of debts without going into NPL. There were regulatory changes for institutions, and we know that the peculiarity of this shock, the pandemic, is that it modified the way we related with each other and the way we worked. We were working remotely, and this was from one day to the next. This meant that the institutions were not able to fulfill all of the regulatory reports as they had done, and the authorities reduced the need for some of the unnecessary reports during the crisis. And also there were changes in the liquidity rules. The institutions could use their liquidity reserves without having any problems with the regulatory supervisors. There was an increase in provisions. And another key factor was the response of the bank, the central bank. There was an increase in the measures to provide liquidity in general to financial institutions. We reduced the monetary regulation deposit, which is like a reserves requirement. It's similar to this, and this released liquidity. The arrival of this, this was made easier with collateral. There was an increase of liquidity in certain markets and corporate reports. All of this was aimed at increasing liquidity, and orderly behavior of the markets was promoted with financing in dollars and other measures. There was other help also to support the economy. In particular, there were two which allowed the channeling of resources through the banking sector in order to be able to provide credit to individuals or to SMEs. The four key point with regards to resilience was that all of these measures were withdrawn in an orderly way. It was announced far in advance when they were going to be withdrawn, and there was a calendar for their gradual withdrawal. This meant that the markets and the institutions could adapt and prepare for the removal of these systems. And then the nature of the crisis itself. It was sudden. It had an impact on the economy because of social distancing that were imposed. But there were expectations. It was expected suddenly, and it was expected that it would end suddenly, and at that time it was expected that the economy would return to normal. These expectations led to people being very careful with regards payment holidays. And I shall stop with this point, and we can continue later on talking about further challenges. Thank you very much, Jorge, for sharing the Mexican experience. We are converging on different points regarding resilience of the system, the financial system in the region during the pandemic. Particularly, you've mentioned about flexibility in supervision and regulations and the robustness which existed, and also actions taken by monetary authorities. So, very good. We'll continue now with the contribution of Paul Castillo, who is going to talk about the Peruvian experience. He is currently the manager for monetary operations and financial stability in the Central Reserve Bank of Peru. He has also been in charge of monetary policy in this entity. You have the floor. Thank you. Thank you to Carlos, Adriana, CAF and FLAR for organizing this important forum. In the case of Peru, it's true that we've seen resilience in the system, and it's been a channel for counter-cyclical policies applied by the central bank in response to this crisis. We could recall that in Peru, there was a lockdown which was one of the most severe in the region, and we saw GDP which dropped in April 40%, in the second quarter 30%. But then after that, there was fast economic recovery, and the 40 of 2020, the drop was only 1.7%, and we are convinced that the response was due to the counter-cyclical effect as a result of offering credit to companies in such a way that they were ready to operate as soon as the lockdown was reduced or eliminated. And the central bank implemented a policy which was very aggressive, we could say, between March and April. It reduced the interest rate from 2.25 to 0.25, one of the lowest in the region and in the emerging economies. And in addition to this, it injected liquidity to a very large degree, one of the largest in Peru, almost 8 points of the product, with different collateral and securities issued by the government, foreign currency, and above all, an instrument that was created in response to the crisis with close collaboration between the central bank and the Treasury, which was the reactive program which allowed financial entities to provide credit to companies up to 3 times the sales that they had on a monthly basis. And credit was given to companies that had good risk rating. And then this credit had a guarantee from the government. The guarantee made it collateral which we could use for reporting purposes. 56 billion soles were provided in credit, and 52 were for reporting activities, and the difference was funded using the liquidity of the banking sector. It reached 500,000 companies, and many of these were SMEs. This expansive position, this stimuli that was given, meant that credit in 2020 grew for companies by 20%, 24% for SMEs. And the following year, the economy grew by 13.3%. We are convinced that this response, countercyclical response, was fundamental for this recovery. If we talk about MPL, this increased very slightly, and this is important if we talk about Chile, Colombia, Mexico. We had collaboration, and the authorities facilitated the possibility. 36% of the portfolio was restructured during the peak, which was June 2020. And so far, only 5.6% has been restructured. And this reflects the consumer sector, and services have offered or provided greater employment in order to reactivate things. If we talk about default, it was 3.2 before of the portfolio went up to 3.2%. It went up to 4% during 2021 and has been relatively stable during 2021. If we look at profitability, the banks reacted quickly with this shock, and in 2020 there was a strong movement with voluntary provisions with capital surpluses that the entities had, above all the big ones. This affected profitability at the time, and return on asset went down to the lowest level. And however, afterwards it recovered. It's around 1.4, which is below pre-pandemic levels. We've seen capital levels around 14.8%. The overall ratio, they've been sufficient, or a lot of efforts to capitalize assets with smaller entities in sensitive sectors such as consumption, and greater efforts were necessary there. So if you look at all of this, I would say that just as in the case of my colleagues, in the case of Peru, it's been fundamental, the fact that we had a good initial financial situation. Solvency rates were levels were high. We had vulnerabilities which were common, for example, dollarization. Dollarization in Peru has always been a vulnerability which created fragility in the system, but since the end of 2010, 2011, the central bank has made efforts to speed up the process, and the level of dollarization around 80% of the portfolio. Until before the pandemic, it had fallen to 22%. And if we look at family portfolio, the most vulnerable one, we're talking about levels of below 7%. This reduced vulnerability was fundamental in order to be able to absorb this shock. And this has been an adjustment variable. And secondly, the response of the governor and the central bank, which allowed the system to have the capacity to be counter-cyclical in a difficult moment, as we saw in 2020. And also the coordination has been key between authorities in order for this process to be dealt with in an efficient way. We haven't seen a negative impact of the withdrawal of the stimulus. We had the repos system. We've seen the amortization of a third of the portfolio with liquidity levels they are maintained with high levels of liquidity. The combination of the fact that we were prepared and the fact that we reacted quickly, I think this has shown itself to be a very effective combination when it comes to facing shocks which are completely different, as in the case of COVID. And that's what I would say for this first round. Thank you very much for those comments. We can see that the financial systems in our region have been very resilient during this pandemic. We see indicators that are remaining at appropriate levels, even after the withdrawal of the extraordinary measures, which we have heard about. Their withdrawal has been done in an orderly way and gradual. This has meant that the economies could begin the new credit cycle with a stable situation. And good performance is the result of a solid, robust system prior to the crisis, but also due to flexibility in supervision and regulation and agility with regard to monetary policy. In the future, the challenges are considerable in terms of financial stability. And in the next round, we are going to hear about this. This will be moderated by Adriana Ariasa. Thank you. You have the floor, Adriana. Good morning, good afternoon. Thank you, Carlos. Thank you for joining us, and it's a pleasure to be here. So now we have the second round. Earlier we've heard about things that which I think are very interesting with regards to resilience, that this crisis, unlike the crisis that normally affect the region, as Rodrigo, Daniel, and Jorge Luis highlighted, it was not a microfinancial crisis, but a health crisis. And secondly, the systems had macro systems which were prudential and robust prior to the crisis. And when the crisis came along, there was an appropriate response by the regulators and the central banks, and the measures were withdrawn in an orderly way, and the economies could recover. All of this meant that the financial systems maintained solvency and liquidity, but it also had a counter-cyclical effect, which had hardly been seen in the past. But now we are talking about a global situation which is more complex, and this will no doubt have an impact on recovery in the region. It will have an impact on the performance of our economic system. So we are talking about interest rates now, and the central banks and their policies. So we could talk about the effect and challenges of this increase in international interest rates led by the Federal Reserve of the United States, and how inflationary pressure and monetary policy responses could represent challenges for the financial system, and what other factors may affect macroeconomic and financial stability. So with regards to all of these issues, we're going to start off with our friend from Colombia, Daniel. Okay, I would like to share my screen again to talk a little bit about the challenges in this regard. I think that the challenges for financial stability in the case of Colombia and, well, the region, I think we have two. One is related to international financial conditions. We hear talk about the interest rates, and I would go on to talk about, well, as you said, Adriana, we're talking about things related to risk investment, and the risk or the clear challenge is how to face changes which can be quite sudden, and the key word is sudden. I'm sorry, but in the booth we lost the sound there for a moment. Here in the chart, this is something I got from the last financial stability report of the Monetary Fund. We can see information for advanced economies and for emerging economies. We can see the financial conditions, and we can see how there's been greater pressure. We could say, well, the changes have been quite fast, but the market players anticipated them, and this has been important because it meant that the changes didn't cause great trauma in the markets. We can see the involvement of foreign investment in Colombia, for example, and despite the changes in financial conditions, there hasn't been a lot of changes. And here, of course, the war in Europe has affected the financial conditions on an international scale. I'd like to say something about inflation here. With inflation, we are seeing something similar in that changes, well, inflation has gone up, as we all know, and this has been anticipated to a certain degree, and this has led to adjustments that have not affected financial stability. And inflation has been above what was expected, and this has led to policies that are different to what might have been expected, and this is where we may see changes. Inflation has an effect. It can have an effect on the quality of credit. Certain companies perhaps can't adapt their prices to match their costs, or homes who see their income affected. And the financial system in Colombia is resilient, but it's not so resilient perhaps to stronger changes to international financial conditions resulting from this kind of situation. And something essential here is that as a result of the pandemic in Colombia, we saw quite high deficits, and there wasn't much fiscal space. And the liquidity of the economy was affected when it came to the government wanting to achieve financing. The key is to look at how far it's possible to anticipate the changes. Sorry, but the sound is quite difficult to understand, the speaker sometimes. So here we can see the recovery, but the starting point was different to what we had previously. As a result of the pandemic, we have a legacy, which is high debt in homes and companies, and this has been mentioned by many entities. There was high borrowing, and this means that we're talking about a new borrowing cycle. And we can see on this chart, we have the financial debt for the private corporate sector. It shows, well, we can see in 2020 this borrowing increased. In 2021 there was a slight recovery, but it is still high to its record levels. And in the most of it is local currency, but we could see financial coverage. There's not a lot of exchange rate risk. In the case of homes, we have something similar. There's high debt, and in the GDP, we can see it reached in high levels. In this context, we can see high growth in consumer portfolio. So we're looking at a new stage with higher borrowing and new growth of credit. This will be a challenge for the future of the financial sector. And this is what I wanted to just mention: high borrowing and sudden changes. Those are the key factors. Thank you very much, Daniel. Well, we don't know how far all of this will go and whether this will trigger increases in interest rates and whether we'll be able to anticipate them. And in this new cycle that we are starting, we are seeing, or going to see, homes and companies with higher levels of borrowing, which represents a risk for financial systems indeed. We shall continue with Jorge Luis for the case of Mexico. Thank you very much, Adriana. We are going to notice a difference between, well, if we compare Mexico with Colombia, for example, because one of the main challenges, which was a challenge even before the COVID-19 crisis, and is a challenge now to a greater degree, is penetration of credit is quite low. It fell during the pandemic, and although they have, well, we've begun to see reactivation, it's still not reached levels which we consider satisfactory. We don't see high borrowing in homes or companies. It's not of concern. There are some companies, and above all corporations, are getting finance from abroad. They have natural coverage or derivative instruments for coverage, and it's not a concern. But at a local level, it is a challenge for the future. This will be even bigger challenge, bearing in mind the conditions with increase in rates. And this is something we will have to follow and monitor. Another risk, and I think these are shared risk in the region, is regarding the reversal of capital flows in Mexico and emerging economies. And I coincide with Danielle in that it's important to see how adjustments are dealt with. If they are above what we expected, if they're sudden, then we could expect overreaction in markets and overreaction in capital. In these cases, however, they've been gradual and advanced or anticipated. So adjustments were announced far in advance, and we've seen their effect on capital flows, but it wasn't something sudden. Or it's something that's been observed in a general way for many times, for a long time, not just if we talk about increases in interest rates, but also we have to take into account that in some investment indexes, there will be index. If we talk about China and India, for example, they entered into these indexes, and that complicated investment in other emerging markets with the arrival of greater competition. With this reversal of capital flows, well, it's been gradual, so the impact has been softened on the economy and on exchange rates. What problems might we see in the future? Well, with regards to financing, we've talked about foreign financing. What are the consequences? Well, these large corporations may have an impact which could lead to the displacement of credit that might otherwise reach SMEs. And this could be a challenge for the level of credit at in a local sphere or context. And there is a risk which cannot be foreseen, the risk that we may have acceleration of worldwide economic activity, in particularly in advanced economies. Depending on the speed of the adjustments and the size of the adjustment, it's important to balance it out. The impact might not just be local in advanced economies, but also at a global level through international trade. It could have an important impact if advanced economies, if we see a deterioration in these economies. We have to pay attention because inflation rates indeed may remain high, and there may be the need for a sudden adjustment in some of these advanced economies. This takes us to a conflict which we could see between how to control inflation and have economic activity. We have to balance out the speed of the adjustment and the scale of this adjustment. In the case of Mexico, the Bank of Mexico has striven to fulfill its mandate, which is to control inflation. And appropriate and decisive action has been taken to limit inflation. And this has had an impact in limiting the impact on the volatility of exchange rates and capital flows. In the future, the challenge will not just be at a local level, but at an international level. The increase in rates could increase service debt costs for corporations, and this could have consequences for the quality of the portfolio in the future. In the case of Mexico, credits granted to individuals normally are at a fixed rate, so it's not an issue for individuals, but it could be for corporations and companies. I think that the elephant in the room is not inflation adjustments, but another of the important factors which is leading to the increase in inflation around the world, and this is the geopolitical conflict between Russia and Ukraine. The impact of the pandemic in supply chains had not been overcome when this new shock arrived, which has had an impact on production and international trade, and particularly raw material prices, energy prices, and food prices. This can have a considerable impact on emerging economies, above all those that don't produce these kinds of raw materials. The conflict has increased risk aversion and therefore increases pressure on capital flow. There is concern about volatility in raw materials markets that could have an impact on coverage and derivatives, and this could occur or lead to instability. In the case of Mexico and other countries in the region, these markets are so advanced, but there could nonetheless be contamination from emerging markets to developing markets. Oh, economies, sorry. Also, we need to talk about cybernetic attacks. These were happening before the pandemic, but recently with this conflict, this risk has been exacerbated. We are talking about economies that function globally, and our banking systems have the presence of international banks, and therefore we are not exempt or free from these kinds of attacks. Efforts have been made to protect ourselves against these attacks, but we don't have the same situation in all economies, and the breach of a system in one economy could contaminate or other economies. And this is something that we have to bear in mind. And with that, I finish. Thank you very much. Thank you very much, Jorge Luis, for that. And you've highlighted the fact that we may see an impact if we have a sudden change in and not an expected change in interest rates, but also the geopolitical aspects. I think that there's something worth mentioning, which is about capital flows towards emerging economies, which are changing. There has been a departure from East Europe towards perhaps Latin America and other areas. Some currencies have moved and the sovereign spreads have been reduced. And we are seeing the arrival of this capital in other locations. And so this is one of the consequences. And the crisis is unpredictable, and the region so far has been favored by the situation. Now we're going to hear about Peru from Paul. Thank you. Yes, indeed. I think that the most important challenges for the future are external. The dilemma for central banks around the world is quite complex. A good part of inflation is due to supply shocks. But unlike typical ones, which are transitory with the reversal of price levels, here we have geopolitical factors which mean that the supply shocks may be more persistent. And the risk of higher global inflation and lower growth is a risk that is more and more important. As you mentioned, Latin America, has been favored because raw material prices have been maintained at high levels, and we've seen an appreciation of currencies in the region until March. But the situation could change. And we can recall that the Chinese economy is speeding up. If we saw an upturn that had an impact, we could see an effect on raw materials, and we could see an increase in interest rates. This is more complex compared to the traditional situation in the past with the departure of capital because of a reversal of the stimuli of the Fed. What is fundamental, I think, well, in our economies, in the case of Peru, we have a solid fiscal position and relatively low levels of debt. The ability to have counter-cyclical policies has been reduced, but I still consider that there is some capacity. And with the central bank and the reserves, we have a good position which allows us to take action if there was a liquidity problem. But the scenario is relatively complex. On the other hand, we could talk about risk, and this is perhaps something that we've seen in Peru in 2020, 2021. It was related to elections and uncertainty at a domestic level due to the political situation. There was fear, and this triggered the departure of capital in the case of residents. We saw approximately 7 points of the GDP, which left the country mainly for residents who were looking for alternatives given the uncertainty that existed at a local level. And this can have a more direct impact on the financial situation, since many of those funds were coming from financial institutions that were small or medium sized, with interest rates which were attractive, and they had to face the departure of deposits towards larger banks, or even leaving the country. And it's true that there has been uncertainty and there was pressure on the institutions. It's a scenario that we are studying, and we think that we need to be prepared. Another factor that has been a common factor for countries in the region has been withdrawals of pension funds, which has put pressure on sovereign bonds or sovereign funds. In our case, this has been accompanied by disposals to release special deposits, which are employment insurance funds. These risks are present and could be considerable risks. We don't see excessive borrowing in families. Paradoxically, many people, well, the initial position of the people is positive because have a lower financial burden, and this helps to explain the fast recovery of consumption over the last 6 months. In the corporate sector, despite the fact that they had reactivation credits in many companies, well, they were limited to the number of months of sales or the months during which sales were paralyzed, and at very low rates. So we don't see important risk there. But in international terms, we see more risks, and these factors I already mentioned at a domestic level. If we refer to prior crises, well, it's important to recover solvency levels that we had in the past in order to be ready for any risk scenario which might be more complicated and may appear in the future. And with that, I finish. Thank you very much. You have talked about global risk, additional risk, which is that of the combination of high inflation rates with lower growth that could have an impact, and an idiosyncratic risk, which is the impact that we may see as a result of the withdrawal of pension funds in the case of Peru. This perhaps avoided greater leveraging, but could have implications in the medium term. And in the case of Chile as well, we saw withdrawals from pension funds. And, well, with that, we'll move on and give the floor to Rodrigo to close this round, talking about the pressures in the financial systems. Thank you very much, Adriana. So, well, I won't talk specifically about the current situation. Well, next week we will have our report on the financial situation on the 18th of this month, and we are going to focus in that on what you're talking about with regarding the impact of withdrawals and the size of the capital market. And the size of the capital market, well, an important pillar were those pension funds that underwent large-scale withdrawals as part of the policy implemented. I would like to refer to certain challenges that I think are relevant and should be considered. They're important. We've heard about the Russia-Ukraine conflict or increases in federal reserves, and these are important for the banking sector. We can talk about the increase of applied technologies in the financial sector, what we call fintechs, we have two elements which are relevant for banking sector, the position of the banking industry with regards to whether they're going to be partners or whether they will be competitors. And on the other hand, the regulatory adjustments which the regulators have in each jurisdiction for the inclusion of these systems in a safe way. These technologies which have arrived in recent years. And what's important here is also related to different services that we will see in the future, how they will assign credits, what will be the importance of the score indicators that we use traditionally, and new technologies that may incorporate other kinds of information. And this is a challenge which I think will be interesting to monitor in the future. As I said previously, because of the difficulty of the traditional, or that this represents for the traditional banking system. I will have to see how this is all fitted into the regulatory framework. On the other hand, we have another interesting challenge mentioned by Jorge, which is the increase in IT attacks or cyber attacks, which are not only those which involve fraud and phishing, which try to obtain personal data and money, but also there are other ones which affect IT systems that make the servers crash, and this doesn't just affect the owner of the site, but all of the users as well. So there are two aspects with this. One is the theft and fraud through these attacks, and then the crash of the system, the elimination of the services, and this can have an impact and complicate the financial system and the provision of services. So usually the resources devoted to this kind of risk tend to be quite limited compared to their growth, and we have technologies which are progressing and advancing. And there's a point here which I think is relevant in this seminar, the fact that we need macro coordination. Here we have talked with different peers, and we have to make sure that we share experiences rather than being embarrassed to share information about attacks that we suffer. We need to share information to make sure that if we suffer an attack, others will not suffer anything similar. We need to learn from the experience of others and provide information, share information in order for us all to be protected. As Jorge has said, if one is affected, then others will be affected. This is like a cybernetic pandemic. It's a cyber pandemic. That's all I wanted to say. Thank you very much. Thank you very much, Rodrigo. Thank you to the panelists. It's been very rich in helping us to understand the challenges related to uncertainty at a worldwide level with regard to monetary policy, and we've seen how we have adapted in an orderly way, but we may see unexpected shocks which could reverse capital flows and affect the performance of our financial systems. We've heard about idiosyncratic issues such as the high borrowing in homes in Colombia, or the impact that pension fund withdrawals could have, the impact of those pension fund withdrawals, as we heard about, and we will see, no doubt, in the report that will be published by the Chilean Central Bank about their specificities. We also have heard about 2 key points regarding financial stability in the medium term, which is related to regulation of fintechs and cybernetic attacks. And we have seen these issues, the latest global crisis, where we've seen the products and there were products being offered in a financial sector that had no regulations. We have, of course, the cryptocurrencies, fintech activities, and all of this is of great interest in the future if we want to ensure stability and make sure that the regulatory system works. There are questions from the audience. Many of them have been covered by the participants, so we shall bring the panel to a close right now. I would just like to say thank you to Rodrigo, Daniel, Jorge, and Paul for their presentations and remarks. And just say that we look forward to seeing you at a future event, and thank you to Carlos as well. It's been a pleasure to work with you for this event. Nothing further to say from me, so I'd just like to wish you a very good day or evening, and thank you to all of those who have participated. Thank you very much. Thank you very much. Thank you. Thank you. Thank you very much. It's been a pleasure.